This is not financial advice, just for education only. If you found this helpful, please like and subscribe. So, what if I told you there was a way to decide on a price you're willing to pay for a stock and then get paid while you wait for it to drop to that price? That sounds almost too good to be true, but it's the fundamental concept we're exploring today. Imagine you've been watching a company, let's call it Awesome Inc., ticker symbol AW. You've done your research, you believe in its long-term potential, you'd love to own its stock. The only problem is that right now, AWE is trading at $100 per share and you feel that's just a little too expensive. Your analysis says a better entry point is $90 per share. Normally, you'd have two options. First, buy at $100 and hope it goes up from there even if you feel you're overpaying. Second, set a limit order at $90 and wait. The problem with waiting is your money is just sitting there doing nothing. The stock might take weeks or months to hit your target, or it might never get there at all. This is where our strategy changes the game. Instead of letting money sit idle, you can put it to work. Use a specific tool, an options contract, to make a deal with the market. You're telling another investor, I'll buy 100 shares of AW at $90 by a certain date. In exchange for that promise, they pay you a small fee now. That fee is yours to keep no matter what happens. This shift, getting paid for patience, is the core idea. You move from passive waiter to active participant. If the stock never drops to $90, you keep the fee and your cash. Repeat the process. If the stock does drop to $90, you buy at your target price and still keep the initial fee. Effectively, you bought the stock for even less than your target. This is the art of buying stocks at a discount. The tool that makes all of this possible is called a put option. Now, don't let the name scare you. The concept is actually pretty straightforward. When you sell a put option, you are selling someone else the right, but not the obligation to sell you 100 shares of a specific stock at a predetermined price on or before a certain date. You are the one selling this contract, you are making the promise, and you are collecting the money for selling it. This fee is called the premium and it's deposited into your account immediately. The cash secured part is critical. This isn't gambling or using borrowed money, it means you must have enough cash in your brokerage account to buy the 100 shares if assigned. For our Awesome Inc. example, a $90 target strike requires $9,000 set aside. That's $90 times 100 shares. Now the steps? First, pick a stock you want to own long-term. Second, choose a strike price below market. Third, pick an expiration date. Finally, sell one cash-secured put per 100 shares you'd buy. The premium is yours immediately. Then wait until expiration. If the price stays above $90, the option expires worthless. The other investor won't sell, you keep the premium, your $9,000 is freed, and you can repeat. If the price falls below $90, you'll likely be assigned. You buy 100 shares at $90 each using the reserved cash. You own the stock at your discount, and you still keep the premium. To really get comfortable with this strategy, we need to make sure we're all on the same page with the terminology. These words might sound technical, but they represent very simple ideas. Premium, strike price, assignment. Let's start with the most important one, the put option. A put option is just a contract. It gives its owner the right to sell a stock at a specific price. Since we are selling the put option, we are on the other side of that deal. We might have to buy the stock. Think of it like a store offering a price match guarantee. You are the store promising to buy an item at a certain price if it drops. Next up, the strike price. It's the price at which the deal is set. The price per share you agree to pay if assigned. When selling a cash-secured put, you choose the strike price. Pick a strike you'd be excited to own the stock at. If a stock trades at $50, you might choose $45. Then we have the premium, the money you get paid. It's income you receive immediately for selling the put. It's the other investor's payment for the right to sell you their stock later. The premium varies based on a few factors, like how far the strike is from the current price, how much time until expiration, and how volatile the stock is. But that premium is yours to keep, forever. It's non-refundable. Finally, assignment. Assignment is what happens if the stock price falls below your strike at or before expiration. The buyer exercised their right. Now you must fulfill the contract. You are obligated to buy 100 shares at the agreed strike price. This isn't bad. The strategy aims to generate income or buy a stock at a discount. Assignment is simply getting the stock at the price you wanted. You wanted it at that price, now you have it. Now that we understand how selling a cash-secured put works, we can take it to the next level with a strategy that investors call the wheel. It's called the wheel because it's a cyclical process that you can, in theory, repeat over and over again to continuously generate income. It's basically a system for what to do in either outcome of your cash-secured put. The strategy has two main phases and it just keeps rotating between them. The first step of the wheel is exactly what we've already been discussing. You sell a cash-secured put on a high-quality stock that you would be happy to own for the long term. You choose a strike price below the current market price, your ideal entry point. You collect that instant premium. Now you wait. If the stock price stays above your strike price by the expiration date, the option expires worthless. You keep the premium, and you still have your cash. If this happens, you simply repeat step 1. You can sell another cash-secured put, maybe at the same strike price or a different one, and collect another premium. The second part of the wheel strategy begins if and when you get assigned the stock. This happens if the stock price drops below your strike price, and you are now obligated to buy 100 shares at that price. So now you own the stock. Your goal has shifted from trying to buy the stock to generating income from the shares you now hold. You move on to the next phase of the cycle, which involves selling what's called a covered call. This is essentially the opposite of a cash-secured put. You are now selling someone the right to buy your 100 shares from you at a higher price. When you sell a covered call, you again choose a strike price. This time, above the price you paid for the stock and an expiration date, and you collect another premium. If the stock price stays below your new strike price, the call option expires worthless. You keep the premium, and you still own your 100 shares. If the stock price rises above your strike price, your shares will be called away, meaning you sell them at that higher price for a profit. And what happens now? You're back to holding cash and the wheel turns back to the beginning. You can go right back to step 1 and start selling cash-secured puts all over again. Let's make this crystal clear with a simple step-by-step example. Imagine you want to own shares of a solid blue-chip company, Blue Sky Corp. Ticker Sky, currently trading at $52 per share. You think that's a bit pricey, you'd much rather buy it at $50. You have $5,000 ready to invest. Here's how you could run the wheel. Step 1. Sell a cash-secured put. You sell one Sky put option contract strike price $50 that expires in 30 days. For selling this contract, you immediately collect a premium of $100. Your brokerage account secures the $5,000 needed to buy the shares if assigned. Now, we wait 30 days for one of two outcomes. Outcome A. The stock stays above $50. At expiration, Sky is trading at $51 per share. Your put option expires worthless. The $100 premium is yours to keep. That's a 2% return on your secured $5,000 in just 1 month. 100 divided by 5,000. Your $5,000 is now unlocked. You can now turn the wheel back to the start, sell another $50 put for the next month and collect another premium. Outcome B. The stock drops below $50. Let's say at expiration Sky's price falls to $49 per share. You are assigned. You are now obligated to buy 100 shares of Sky at your strike price of $50 per share, which cost you the $5,000 you had set aside. You are now the proud owner of 100 shares of Sky. But here's the cool part. Because you also kept the $100 premium, your actual cost basis per share isn't $50. It's effectively $49 per share. $5,000 minus $100 divided by 100 shares. Now, you're in the second half of the wheel. Step 2. Sell a covered call. You now sell one Sky call option contract strike price $53 that expires in 30 days. For this, you collect another premium of $80. If Sky stays below $53, the call expires worthless. You keep the $80 premium and you still own your shares. You can sell another call for the next month. If Sky rallies to $54, your shares are called away at $53 each. You sell your 100 shares for $5,300. You made a $300 capital gain, $5,300 minus $5,000, plus the two premiums, $100 and $80. Now you have cash again and the wheel begins anew. As great as this strategy sounds, it would be irresponsible not to talk about the risks. This is not a risk-free way to make money. Go in with your eyes wide open. The biggest risk? The stock's price could fall dramatically, far below your strike price. Example. Sky stock. You agreed to buy it at $50. But then terrible news hits, and the stock plummets to $30 per share. You are still obligated to buy it at $50. You will immediately be holding a stock with a significant unrealized loss. This is exactly why the single most important rule of the wheel exists. Only ever use it on stocks you genuinely want to own for the long haul. You should be comfortable holding the stock even if it goes down after you buy it. If you were just chasing a premium on a garbage company you didn't believe in, a situation like this would be a disaster. But if you've chosen a high-quality, fundamentally sound company like Blue Sky Corp, you might be more patient, confident that its price will eventually recover. Another limitation is that your potential gains are capped. When you sell a covered call, you are agreeing to sell your shares at the strike price. Say you sold a covered call on Sky with a $53 strike price. Then the company announces a groundbreaking new product, and the stock shoots up to $70 per share. You still have to sell your shares for $53. You would miss out on all of that extra upside from 53 to 70. This can be frustrating for sure. You are essentially trading away the potential for huge, explosive gains in exchange for more consistent, smaller chunks of income from the premiums. Finally, there's the risk of being stuck in one phase of the wheel for a long time. If you get assigned a stock and it enters a long-term bear market, its price might stay depressed for years. You could be stuck holding those shares, selling covered calls for very small premiums, and waiting a long time for the price to recover enough for you to sell the shares at a profit. This is why you must have a long-term mindset and only use capital that you don't need in the short term. The wheel is a marathon, not a sprint, and it works best for patient investors who are focused on cash flow over fast growth. So, there you have it. A complete breakdown of how you can potentially get paid to wait to buy stocks you already want, and then continue to get paid once you own them. We started by selling a cash-secured put, which lets you collect a premium for your promise to buy a stock at a discount. If you get the stock, you move on to selling covered calls, collecting more premiums until the stock is eventually sold for a profit. This cycle, the wheel, is a powerful strategy for generating income, but it requires a solid understanding and a disciplined approach to be effective over the long run. If this strategy sounds interesting to you, your homework starts now. The first step is to learn more. Read books on options, watch more videos, take a course. Many online brokerages offer extensive educational resources on options trading, and you should consume all of it. It is absolutely critical that you understand every aspect of these contracts before you put any real money on the line. Knowledge is your best defense, and the more you learn, the more confident and successful you are likely to be. Once you feel you have a good theoretical grasp, the next step is to practice without risk. Almost all major brokerages offer paper trading accounts. These are simulators that let you trade with fake money in the real, live market. You can practice selling cash-secured puts and covered calls, tracking your fake profits and losses and getting a feel for the mechanics. This is an invaluable step. It lets you make your beginner mistakes without any real-world financial consequences. Don't skip this. Treat your paper trading account as seriously as you would a real one. Finally, if you decide to move forward with real money, start small. Be patient. The wheel is a long-term strategy, not a get-rich-quick scheme. Your goal isn't to hit a home run on every trade, but to consistently hit singles and doubles, generating a steady stream of income over time. Focus on high-quality companies. Stay disciplined with your rules. Never sell a put on a stock you wouldn't be thrilled to own. By combining patience, continuous learning, and a disciplined strategy, you can put your capital to work in a smart and efficient way. Thank you so much for reading, and I'll see you next time.